My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you a little money. My job is not just to entertain, but to educate, teach, put it in context. Call me, 1-800-743-CNBC, or tweet me at Jim Cramer. Now, we can rebound from our lows like we did today. Dow ultimately declining just 30 points. S&P advancing 0.45%, and the Nasdaq gaining 1.04%. But we aren't going to get a sustained run in this stock market until we get a resolution to the debt ceiling crisis. In the meantime, everything else is just noise, including Wall Street's love affair with artificial intelligence and a cooler consumer price index number this morning that may have pleased the Fed. But even if we just stop the rate increases, if we don't stop this debt ceiling problem, well, there's problems. There's real problems. What's my reasoning? Well, it's based entirely on what happened the last time we had a debt ceiling crisis, 2011. Long term, it didn't really matter, but short term, it was an absolute nightmare. And I felt the full brunt of it.
The House of Pain.
Well, I'm determined to remain constructive during this period, and that's my operative word, constructive. I recall the wrangling in 2011. It was so ugly and fraught between both sides that it's worth remembering how quickly the Dow Jones Industrial Average was just slaughtered pretty much out of nowhere. The timeline was clear. We knew the government was going to run out of money by August 2nd of that year. Both sides played a game of chicken for a little more than a month. Beginning in earnest during the third week of July, Dow was at 12,724. The deal wasn't reached until the Dow dropped almost 900 points, a deal that came in part because lawmakers were worried that they themselves were causing a multi-day stock market crash. But the nightmare didn't end with the Dow at 11,866.
The House of
Nope,
Pain.
we got a second leg down when the Standard & Poor's, the organization, the entity, unsatisfied with the budget agreement, downgraded the debt of the United States government. Because who trusts the bonds of a country that might default on its obligations purely out of political dysfunction? That caused the Dow to swing all the way down to 10,809. Finally, that was the end of it, though. A vicious 19% decline, peak to trough. There was very little negative follow-through after the downgrade, and the market quickly had a furious rally. And it was so good you couldn't miss it. That is another reason why I'm trying to stay constructive. Now, this time around, the situation is more complicated. If we just had the Fed continuing to raise interest rates on top of the debt ceiling debacle, well, that would be enough to give us a hard time. If we were just running into the first cracks in the economy from the last 500 basis points of rate hikes, well, then we'd expect to see some downside volatility. If we didn't have that banking crisis that threatens to derail commercial real estate, at least the lending to it, and small business credit to boot, well, we could rest a little easier. But those are worries galore. They're just worries. But all this market really seems to have going for it right now is generative AI and the companies that can profit from it, which is a pretty slim read, although a bountiful one if you're members of the investing club, where NVIDIA and Apple are own, don't trade stocks, and Microsoft and Salesforce are giant positions. So the backdrop of the debt ceiling and deficit talks is more muddled than back in 2011. Worse, both parties seem to hate each other far more than they did a decade ago. The rhetoric this time is a lot more toxic. Obviously, there was plenty of toxicity in 2011, too. But I think there was a lot more good faith on both sides back then. The Democrats were willing to cave on spending cuts. The Republicans' leadership didn't really want to force it to fall. The process was incredibly acrimonious, yes, indeed, but we did get a deal in the end. This time, there's nothing. The Republican leadership almost seems eager to trigger a default to kick the Democrats out of the White House. Meanwhile, President Biden doesn't seem to even negotiate. He's fielded the idea of invoking some language from the 14th Amendment to insist the White House has the obligation to pay all its government's bills no matter what. Is it a legitimate solution? Listen, Lawrence Tribe, eminent legal scholar that President Biden mentioned as being in favor of invoking the 14th Amendment, disagreed with his own position back in 2011. But the real problem with this plan is that it would trigger a huge constitutional crisis. I'd expect to see a couple disastrous down days for the market, with the matter ultimately being decided by a Republican-dominated Supreme Court, which would probably just kick things right back to Congress where we started. If you think the S&P downgrade was a nightmare, can you imagine what that debacle would bring? We got 19% peak to trough in 2011. I don't even want to think about how hard the market would get hit in the constitutional crisis. Maybe the rating agencies would feel that they have no choice but to downgrade again, perhaps to deadbeat status, as Secretary of Treasury Janet Yellen opined the other day. So why not just sell everything? Okay, well, there are plenty of reasons not to. First, there's always the possibility we get an agreement. Remember, they didn't want to crash themselves in 2011. Things seemed incredibly hopeless in 2011 until suddenly we got the compromise. If you sell before that happens, you could miss out on one of the most explosive rallies that we may ever have in our lives. Second, we aren't far from the end of the Fed's tightening cycle. We got a cooler inflation number today, and when the Journal reported the Fed liked the number, the market had a dramatic midday rally. By itself, that's not enough for the Fed to take a break, but it certainly didn't hurt. Finally, there's plenty of fear about the banking business and how it could hurt the real economy. There are plenty of cyclical stocks that are joining the banks in weakness. Those stocks are the kind that rallied furiously after the debacle in 2011. I don't want to miss that move either. If you get a near default or even a constitutional crisis that's solved at the end of the month, you're also going to get some softer wages in the June employment report, at which point stocks will get much more attractive because then the Fed will be done. In that case, you're going to regret paying attention to all this debt ceiling wrangling altogether and might have less of a chance to get back in than you did in 2011. It's not too risky to raise some cash here, though, but it's too risky to leave the market entirely, especially if you consider what Carly Garner told us last night in our off-the-chart segment. She said short selling is already at record levels. Still, let me tell you why I'm more perturbed than most about the particular debt battle. In 2011, the debt ceiling issue really hit home. I had attended the Philadelphia Eagles training camp during that period, and a host of players were incredibly worried and were asking me about what it meant for their salaries and savings, for our debt to be downgraded. They felt it was going to change their lives. I was just trying to find out who was going to get cut. This issue really hits home with our watchers, with you. I bring it up to show how this was a faux business story that became a real-life national story and scared the heck out of people. When you couple that with the words broadcast by us from a guy like Stanley Druckenmiller, still one more billionaire who doesn't like what's happening and fails to choose his words carefully, and you get the possibility of another generational exit from the market occurring just when you should be buying. Now, I think the world of Druckenmiller, he's been right. He's absolutely right. There's been way too much stimulus. Fed kept rates too long, way too low. But the stimulus is long gone, and the Fed's been tightening like crazy. Come on. He said in delivering alpha in 2022, he's made a lot of mistakes, but he owned up to them. Well, you know what? So's the Fed. Sadly, the billionaire class is never going to tell you to buy anything. When you're already that wealthy, you tend to have very different financial priorities from our viewers because you only need to get rich once, and I'll never forget that. So let's do this. Raise some cash. We told people on our home stretch segment for the CNBC Investing Club we'd sacrifice even some of our generative AI winners because they're overheating. We've taken our cash position higher for the Charitable Trust, as club members know. But then you wait. Do we get another 19% peak-to-trough decline like 2011? I don't know. But I'll tell you one thing. We'll be ready to put money to work if it happens. The bottom line, I do know we haven't seen the worst of the debt ceiling fight. So don't make a move unless you're buying a stock that does well in a recession, because that's what Wall Street will presume we're going to go into if this battle drags on. But when I say raise cash, I don't mean all cash. And as club members, many of you know, we will be doing some buying individual stock declines like we always do. Marcus in New Mexico. Marcus.
Hey, Jim, my guy. How are you doing?
I am doing well, Marcus. How about you?
Oh, great. Thanks for taking my call. The stock I'm calling about today has been, in my opinion, unjustly beaten up due to the turmoil from the regional banks. Is right now a good time to add to my BlackRock position?
Okay, I want you to do it in two stages. First of all, I totally agree with you. I want you to do some tomorrow because we're down a lot. And then I want you to wait a little until we see if we get a little more negativity into this debt ceiling edition. But here's what made me think about it. I was shocked to see that the stock of Larry Fink, a man I admire tremendously, has a 3% yield already. So here's what I do. You buy some here. Then you buy someone that gets to 3.5. And then you buy someone that gets to 4% yield. That's how I like to buy stocks like that in those increments. Go to work. Kevin in Texas. Kevin.
Booyah, Jim. How's it going?
Well, I'm doing quite well. How about you?
Well, good. Shout out to baby Papo and my niece Olivia Marco.
Of course. I mean, I can't think of something that was right on the top of my mind myself. I'm glad you brought it out.
I got a question today about NVIDIA and AMD. We've seen a bull market run in these two stocks recently. I'm wondering, should I keep holding on or should I take some off the table or add?
Oh, don't you take them off the table. Look, our status on NVIDIA is clear. Own it, don't trade it. AMD, a lot of people blew out of it at 82. You know what they're thinking? Turn the channel. I can't take it. That Cramer made us so much money if you had stuck with it. That's what I say. Jeff in New York. Jeff. Jeffrey.
Hey, booyah,
It's
Cramer,
Jimmy Chill. Speak to me.
How you doing?
Good. How about you?
Good. Hey, I had a quick question about Regeneron, R-E-G-N.
I'll give you a quick answer. I like Regeneron very much right here at 750. Len and I were talking. I was talking to a very good friend of Len's just the other day, Dr. Len Schleifer, and we both were remarking, how can this stock sell at only 18 times earnings? It's got so much game. I say buy Regeneron. Boy, does that stock do well in a recession, too. That stock actually needs a debt default. I'm going to Trey in Texas. Trey.
Jim, the cost to own shares of Wingstop may be over $200, but I fear the cost of not owning them is a lifetime of self-loathing. What do you think?
A lifetime of self-loathing. Since I've had one, I can totally agree with you. I like Wingstop. We just had them on very much. I like it when Charlie Morrison was on doing it. So the Super Bowl. I think Wingstop is really good. It's really hard to get. The only way to get a franchise is to be incredibly successful at other franchises. How can you miss their price of wings going down? Watch that Tyson conference call. I say buy. And I like these callers because they have horse sense. All right, we aren't going to get a sustained run in the stock market, though, until we get a resolution of debt crisis. Everything else is kind of just backing and filling, flopping and chopping. In the meantime, don't forget, tune out the noise. We are remaining constructive. All right, man, tonight, we're breaking through that noise with a look at some key industrials, starting with retail. Don't miss my exclusive with the CEO of Tanger to find out what the consumer is signaling. Then AI is taking the market by storm, and autonomous vehicles could be one of the biggest secular growth themes of the decade. We're talking with the GM-backed Cruise as they continue to expand their footprint. And speaking of AI, it could be an artificial intelligence that takes your order the next time you get a craving for a Baconator or a Frosty. That's right, Wendy's has unveiled plans to add AI technology to its drive-thru. What the heck is that stock doing right here and not much higher? Don't miss my post-exclusive, earnings exclusive with the fast food chain CEO to learn more about the move. And stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.